An increasing number of macroeconomic indicators are confirming what the market most feared, a possible recession that continues to draw nearer. Inflation levels are at their highest in decades, and the supply chain breakdown further diminishes any optimistic outlook. This pessimism and gloom have permeated all areas of the economy, including financial markets. Investors, however, find themselves in an interesting position, one that presents an opportunity to sail through this recession with the right choices made. With a solid recession-proof investment portfolio, investors can adequately safeguard their net worth and quality of life from being compromised as a result of these wider economic uncertainties. The key to building up such a portfolio is to ensure a good mix of stocks that tend to thrive during such conditions. This video presents the 5 best stocks that could safeguard your capital during the oncoming recession. The first stock we present is the U.S. utilities giant, WEC Energy Group Incorporated, which trades under the ticker WEC. The company provides natural gas, electricity, and renewable energy through its various subsidiaries, and holds a market capitalization of almost $32 billion. The utilities industry is typically seen as a favorite amongst retirement investors, and those with a financially conservative outlook. This is in large part due to the stability offered by energy companies, as well as dividend income and steady growth. It is these features that make the industry ideal to turn towards during the fears of a recession. WEC currently stands as the best investment opportunity in the utilities sector. For one, the company's dividend yield presently stands at over 7%, which is phenomenal for an energy company. The stock is a clear moneymaker that would allow investors to thrive in conditions where they are faced with hard inflation. Moreover, the company's financial trends make its stock quite promising to hold on to. It has benefited from the prevailing inflationary environment, causing both revenue and earnings to see a massive jump. This is precisely the type of stock you want your capital parked in during tough times. A stock that is well suited to profit during these circumstances. What we also like about WEC is its wider sustainability in its commitment to renewable energy. This is a global trend that continues to see momentum, which makes WEC great to hold for the long term. For these reasons, we strongly believe WEC is not a stock that investors should overlook during this recession. The second stock on our list is Brookfield Infrastructure Partners LP, which is more commonly referred to as BIP. The company is in the multi-utilities industry, whilst also being at the forefront of both transport and digital data infrastructure. With its involvement in operational electricity and natural gas transmission, track, train and motorway transport, as well as telecom and fiber optic network, BIP has diversified itself to some of the most stable, rock-solid areas of the economy. This stable and sustainable business model is one that has consistently allowed Brookfield Infrastructure to bear fruit. In just its recent quarter, the company saw its revenue grow 26% on a year-on-year basis. Its funds from operations also saw an impressive 15% climb. Results of this nature are highly promising in a context where the wider market braces itself for a business slowdown. BIP is a stock you cannot go wrong with, especially in a recession context. Across all its segments, the company excels in asset management. Brookfield Infrastructure identifies ideal asset investment opportunities at lower multiples, and expertly manages them to achieve phenomenal levels of capital payback. Following this, the company strategically sells these assets at impressive premiums, and thus boosts its growth and financial sustainability. A recessionary environment provides a fresh opportunity for this strategy to deliver success. Following this robust strategy, BIP has grown remarkably by nearly 400% since its inception in 2009. The company has also been generous in sharing this growth and profitability with its shareholders. Since its inception, long-term distributions have grown by a compound annual growth rate of 10%. This makes the stock optimal to recession-proof any investor's portfolio. Before we proceed to the next stock on our list, we hope the options presented in this video so far have been insightful. If the list has proven beneficial to you so far, do subscribe to our YouTube channel and turn on the bell notification. Furthermore, we also offer a morning newsletter to our email subscribers. You will get an overview of key earnings reports, recent insider transactions, analyst upgrades, and downgrades. To take advantage of this offer, you can find the link in the description box. If the list has proven beneficial to you so far, we would appreciate you clicking on the like button to show your support. Up next, we present the REIT, American Tower Corporation, the telecommunications giant, which trades under the ticker AMT. On a global scale, AMT is definitely one of the largest functioning REITs out there. American Tower has a market cap of $120 billion, and holds a portfolio of almost 220,000 communication sites across the globe. The future for AMT looks increasingly bright. In the decade that followed 2010, demand for mobile internet has surged by a factor of almost 96. This trend is only likely to speed up, as the world continues its digital transition in the post-COVID status quo, where e-commerce and remote work continues to dominate the mainstream. AMT, which operates at such a massive scale, is ideally positioned to capture the gains coming from these global trends. The company has enjoyed tremendous growth in recent years, owing to its stellar business model. It offers its clients flexibility in how to utilize the leased data sites, which are in line with their digital data requirements. Through its global communications network, it is able to provide the highest data speeds at the lowest costs, which delivers at a tremendous competitive advantage. This has not only caused the company impressive organic growth over the years, but also results in robust cash flows, despite the wider macroeconomic slowdown. In addition to this organic growth, American Tower has increasingly been expanding through acquisitions. These purchases of telecommunications and digital infrastructure companies have been strengthening AMT's global network, and further enhancing its efficiency. Recent acquisitions have also expanded the AMT market, to include countries in Latin America and the Asia-Pacific region. The stock clearly has all the great markings of an investment, to take shelter in amidst a macroeconomic slowdown. The fourth stock on our list is the 3M Company, which holds the ticker MMM. 3M operates as a diversified tech company, with 4 core segments. These include healthcare, transportation and electronics, safety and industrial, as well as its consumer segment. In the bear market conditions experienced this year, 3M was one of the stocks that took a heavy beating. Where the wider S&P 500 index fell by almost 10%, 3M fell by nearly 36% in the last year. However, when others react in a panic, we see opportunity. In the mass sell-off that had driven down the price of 3M, its valuation alone screams that the stock is a strong buy. Its trailing dividend yield has been pushed up to almost 5%, whilst its forward earnings yield forecast is nearly 9%. In comparison to the wider tech industry, these figures are extremely impressive. Moreover, 3M is pretty well positioned to ride an impressive growth wave in the following years. The expected tailwinds that analysts foresee, in both automation and electrification, would be crucial for the 3M company. This would further be boosted by the semiconductor shortage being alleviated, a trend that already seems to be gradually underway. A dirt cheap stock like 3M, which is on the verge of a rapid rise, is a rare gem that cannot be ignored. For those looking to glide through a recession, this is the exact sort of rare gem to buy and hold. The final stock on our list, but far from being the least, is Public Storage, which trades under the ticker PSA. Public Storage is a REIT, which offers self-storage facilities across the United States. We believe that PSA is a great recession buy for your portfolio. For one, the stock offers all the benefits that any REIT does during conditions of inflation. As the prices of commodities across the economy continue to climb, so too would that of the Public Storage Investment Trust. Moreover, as these costs climb, the revenue of the REIT, and ultimately the income attributable to its shareholders, climb high. PSA in particular, stands well to see a climb of epic proportions in the coming years. For one, it's a giant in its industry, valued at above $55 billion. Its biggest competitor, EXR, has a comparable figure of a mere $23 billion. The total number of storage properties by PSA presently stands at almost 3,000. Amidst the wider market trends, demand for self-storage had been seen as strongly resilient. As demand for housing falls with the worsening economic crisis, households are likely to turn to self-storage for their excess belongings. PSA has been expanding quite a bit since 2019, which indicates its readiness to meet this surging demand, which will continue to climb in a recession context. In just 3 years, the REIT spent $7.5 billion in acquisitions, development, and redevelopment. This amount is equivalent to a whopping 15% of its present market value. The strategy strengthens the company's financial longevity, and boosts its prospects of thriving in a recession. That's all from us in this video. We hope the insight we aim to deliver has proven valuable to you, and would allow you to ensure your portfolio is well suited for long-term growth. We would love to hear your feedback about our list in the comments below. To gain a deeper insight into different stocks that are fit for various investment strategies, be sure to check out our website, stockstelegraph.com.